Mr. Chairman, I would like you to comment in a little bit more depth about one small change I've noted in the statement. It notes that policy will be appropriate to bring, the committee believes, inflation back to the committee's 2% symmetric inflation objective. That's a slight change from the last time when you were expecting it to bring inflation outcomes back near the objective. And I would put this also in the context of a comment you made at the last press conference where you drew attention to the fact that a number of policymakers had projected inflation overshoots 2 and 3 years out under appropriate monetary policy. Should we take all of this together to mean simply that the committee is more confident that a 2% outcome for inflation is already baked in the cake, or that this is a signal that the committee has a stronger resolution to bring inflation at least to the 2% objective and bring into play an informal make-up strategy for inflation? Thank you.
Yeah. So in making that change, our goal was really, that was changing near to returning to, was to avoid possible misinterpretation. So you may remember in the December minutes, we noted that a few committee members suggested that the language that stated that monetary policy would support inflation near 2% could be misinterpreted as suggesting that policymakers were comfortable with inflation running below that level. So we thought about that in the intermeeting period and concluded that it would be appropriate to adjust that language to send a clearer signal that we're not comfortable with inflation rising persistently, running persistently below our 2% symmetric objective. So yes, there is something in that. It's just that we wanted to underscore our commitment to 2% not being a ceiling, to inflation running symmetrically around 2%, and that we're not satisfied with inflation running below 2%, particularly at a time such as now where we're a long way into an expansion and a long way into a period of very low unemployment when, in theory, inflation should be moving up.
Thank you. Nick Timmeros of the Wall Street Journal. I want to ask about the balance sheet. How many reserves are ample? How many reserves does the Fed now think it will need to conduct policy in its current framework? And can you walk me through how you and your colleagues are arriving at that answer?
Sure. So thanks for that question. Why don't I say a few things about repo, since I know that'll be of interest. So just to bring you back, after last September's brief turmoil, we took prompt and decisive action, and as a result, money markets have been operating smoothly since then. Just to review, those two adjustments were Treasury bill purchases of $60 billion, at least into the second quarter, and term and overnight repo at least through April. And I will get to your specific question. The purpose of the adjustments has been to assure that our policy is transmitted smoothly to the federal funds rate, which requires well-functioning money markets. That doesn't mean we're trying to eliminate all volatility in the repo markets. We know that some volatility is normal and expected in well-functioning markets. And as I mentioned, these adjustments have been successful in supplying an ample quantity of reserves. Money markets operated smoothly, including right through year-end, and the Fed funds rate has remained in our target range. So we will know when these adjustments have run their course, when reserves are durably at a level that enables us to control the federal funds rate using our administered rates, interest on reserves and reverse repo, without the need for frequent use of open market operations. Based on current projections, we expect that the bill purchases will durably bring the underlying level of reserves to the ample level sometime in the second quarter of this year. And when we see that we've reached that level, we'll begin to gradually reduce our asset purchases to the level of the underlying trend growth of demand for our liabilities. As our bill purchases bring the underlying level of reserves up to an ample level on a sustained basis, the necessary quantity of overnight and term repo will gradually decline. We've already begun the gradual reduction in the quantity of repo, and we'll continue to reduce those offering amounts gradually as conditions permit. At some point, we'll also raise the minimum bid rate. Even after we reach an ample level of reserves, it's possible that repo operations might play a role as a backstop and support effective control of the federal funds rate. And we'll continue to discuss that issue in reviewing our implementation framework. Coming to your question. In terms of the actually desired reserve level, we know that reserves will continue to move up and down over the course of the calendar year in a wide range, depending on volatility in non-reserve liabilities, particularly the Treasury General Account, or TGA. In particular, reserve levels will need to be at a level high enough to remain ample, even when the TGA peaks during the April tax season. Effectively, what that means is that we need reserves at all times to be no lower than they were in early September, and I would say around $1.5 trillion, subject to learning more. Reserves are going to move in a broad range, as I mentioned, and we want to be clear, that will be the bottom end of the range. We want $1.5 trillion or thereabouts to be the bottom end of the range. So most of the time, reserves will be moving in a range substantially higher than that, but not going below $1.5 trillion. So it's not something that we're aiming at all the time. We know that reserves will fluctuate and be substantially higher than that most of the time. We also want interest on excess reserves and the Fed funds rate to be well within the FOMC's target range, and we think that'll be the case now that we made our technical adjustment. Last points, we're committed to making this adjustment process a smooth one. We'll provide more details as we go, and we expect to learn as we go, as we always have. And we're prepared to adjust the details of the plan as necessary to foster efficient and effective monetary policy implementation.